If you've ever looked at market charts, you know that feeling. You see those little green and red rectangles dancing across the screen, and they might look like simple boxes, but they are actually a really sophisticated visual language.
Today, we are focusing on the advanced vocabulary of that language, candlestick patterns. Our mission is to immerse ourselves in a stack of resources that are all focused on these patterns, the powerful multi-candle formations that can signal a high probability trend shift or, sustained momentum.
And the ultimate goal here is to give you a genuine shortcut. We want to arm you with the specific knowledge that professional traders rely on to pinpoint highly accurate entries and exits. This is really about learning to see market psychology in real time.
Right. And to start, let's just quickly define our core tool. A candlestick represents price action over a specific period. The solid part is the body that shows the difference between the open and the close price.
And those thin lines sticking out are the wicks, or shadows. They show the highest and lowest prices reached in that period.
Exactly. And when these candles combine in specific ways, they start to tell a story of commitment, conviction, and sometimes just emotional exhaustion in the market.
We basically classified these advanced patterns into two major buckets.
That's right. So the most dramatic ones are the reversal patterns.
Yeah.
These signal that the current trend, whether it's up or down, is likely about to pivot completely.
Then the other group.
The other crucial group is the continuation patterns. These tell you the market is probably just taking a pause, maybe consolidating, before it confidently resumes the trend it was already in.
Okay, let's unpack this. Let's dive straight into the heavy hitters, the most potent reversal signals. These often involve just 2 or 3 candles. We should probably start with the one that just screams total dominance, the engulfing pattern.
The engulfing pattern is a universal signal of a really rapid power shift. It's a 2-candlestick structure where the body of the second candle completely swallows the body of the first. This isn't subtle, it's an immediate change of ownership.
And I guess the direction of that bigger engulfing candle tells you who won the battle. So if you've been in a steady downtrend and you suddenly see a small bearish candle followed by a massive aggressive bullish one that just completely covers the first, that's your bullish engulfing.
But what's fascinating here is the psychology behind it. A bullish engulfing shows that not only did buyers overcome all the selling pressure from the previous period, but they drove the price far beyond where the last session closed. It's just undeniable conviction. The sellers, they just evaporated.
Right, and the opposite is the bearish engulfing. That happens at the top of an uptrend. A small bullish candle is just completely overtaken by a long bearish one, and that signals a potential reversal to the downside because suddenly all that bullish momentum from the day before has been completely wiped out.
Yep. The sources are very clear on the application here. You typically enter when the market confirms the reversal. So when the next period starts trading in that new direction.
And risk management is key.
Absolutely critical. Stop-loss orders are often placed just outside the pattern's extreme so, below the low of the engulfing candle for a bullish reversal, and above the high for a bearish one.
Okay, but if the engulfing pattern is such a potent 2-candle signal, why do we even bother with more complex patterns? I mean, things like the morning and evening stars. Isn't 2 enough?
That's a great question, and it really gets to the idea of conviction versus confirmation. While the engulfing pattern is very sudden, the star patterns show a moment of indecision, a pause, and that pause can sometimes make the reversal that follows more sustainable because the market has had a moment to breathe and rethink its direction.
So the morning star is the bullish one. It appears after a downtrend. Tell us how those 3 candles sequence out.
Okay, so it begins with a strong, definitive, bearish candle. Sellers are clearly still in control at that point. Then comes the small, often very short-bodied candle. We call this the market taking a breath. It's that moment of indecision. It shows the bears couldn't push the price much lower.
And then comes the pivot.
Exactly. The final candle is a strong, bullish one. But the real signal, the key detail, is that this final bullish candle has to close above the midpoint of that very first bearish candle.
So it's not just that the buyers showed up, it's that they erased more than half of the previous selling pressure.
That's it. That penetration confirms that the buyers haven't just halted the decline, they have successfully erased the majority of the bears' prior conviction.
And the evening star is just its symmetrical mirror, right? A bearish reversal at the top of an uptrend, a big bullish candle, then that little indecisive pause, and then the final strong bearish candle.
And that third bearish candle must close below the midpoint of the first bullish candle. It signals the bulls are losing momentum, and sellers have stepped in with enough force to undo most of the prior gain. So you wait for confirmation from that third candle, and you set your stop loss right below the low of the morning star or above the high of the evening star to protect your capital. And if we connect this to the bigger picture, sometimes the market doesn't pause with a little star. Sometimes it shifts with just consecutive overwhelming commitment. And this brings us to patterns that are all about raw, uninterrupted momentum over 3 full trading periods.
Right. These are the signals that say the shift is happening now and nobody is stopping it. I'm talking about the 3 black crows and the 3 white soldiers.
These patterns are, well, they're relatively rare, but their appearance is highly significant because they show relentless conviction. The 3 black crows are profoundly bearish. They happen after a strong uptrend and are made of 3 consecutive long bearish candles. Crucially, each candle must open within the body of the previous one and then close lower.
The significance there isn't just that the price went down for 3 days in a row. It's that the bears managed to sustain that aggressive selling pressure with very little pushback day after day. It screams that sentiment has collapsed.
And its bullish counterpart, the 3 white soldiers, provides that same kind of strength, but after a downtrend. 3 consecutive long bullish candles, each opening within the previous body and closing higher. When you see this, it signals a definitive dramatic reversal from bearish exhaustion to pure bullish conviction.
And because these are such strong indications, traders often don't wait for a ton of external confirmation before entering after that 3rd candle closes. The commitment is just so high.
That's right. And for safety, stop losses are typically set either at the highest point of the crow's pattern or the lowest point of the soldier's pattern.
Okay, so let's shift focus back to 2 candle structures. Not the full engulfing ones, but the ones that rely on the depth of the penetration to signal conviction. This brings back that midpoint rule we were talking about.
Exactly. We're looking at the dark cloud cover and the piercing pattern. These patterns rely on the principle that if you erase more than half of what the other side just did, it's a huge psychological victory.
Right. So let's start with the bearish one, the dark cloud cover.
It starts with a strong bullish candle. The next candle opens up, often showing a morning surge of optimism, but then sellers step in aggressively. And that second bearish candle drives the price all the way down, closing below the midpoint of that first bullish candle.
That specific close below the 50% line, that's the critical moment. If the sellers had only pushed it down, say 30 or 40%, it might just be consolidation. But pushing past that 50% mark shows they negated the majority of the bull's previous success. That's a serious warning.
And the piercing pattern is the bullish reversal mirror. You start with a bearish candle. The next candle opens below the previous close, maybe even gapping down, signaling fear. But then buyers step in powerfully, pushing the price up, and the bullish candle closes above the midpoint of that first bearish candle.
It's the market basically saying, we recovered all those losses, and then some. That penetration above the 50% line demonstrates a serious shift toward bullish control.
Yeah, and in terms of application, for both of these, the signal is even stronger when the close penetrates significantly beyond 50%. The deeper it goes, the higher the conviction. Your stop losses are still critical, placed tightly at the high for the dark cloud cover or the low for the piercing pattern.
Here's where it gets really interesting and where we separate the advanced traders from the novices. Why should you never rely on just one candlestick pattern, no matter how perfect it looks?
Because every single pattern has false signals, especially in choppy markets. The sources are absolutely unified on this. Confirmation is essential. Combining a candlestick pattern with a second, unrelated technical indicator enhances your accuracy dramatically. It protects you from those costly fakeouts.
Okay, so we have 3 essential confirmation tools that every serious trader should be using. Let's start with moving averages.
Moving averages confirm the broader trend, and they act as dynamic support or resistance. So if you see a bullish engulfing pattern, that's good. But if that pattern forms right at the 200-day moving average, a commonly respected long-term support line, the signal goes from good to phenomenal. The moving average is essentially validating the reversal point.
Okay, next up, a favorite of many advanced traders, Fibonacci retracement levels. These can sound complicated, but they really boil down to natural ratios we see in the markets.
Right. Fibonacci levels, especially the 38.2, 50, and 61.8% levels, are just notorious for acting as major turning points. So if you spot a morning star forming, and that small, indecisive candle's low aligns perfectly with the 61.8% retracement level after a big run-up, that synergy is incredibly powerful. The levels become self-fulfilling.
And finally, the momentum check, the RSI, or Relative Strength Index. You need to know if the market has simply run too far too fast.
The RSI measures the speed and magnitude of recent price changes. It tells us if an asset is overbought, typically above 70, or oversold, below 30. So if you see a bearish engulfing pattern forming, and at the same time the RSI has been hovering around, say, 75, that combination is deadly. The pattern signals reversal, and the indicator signals exhaustion.
Let's put this all together and see it in action. Let's use the case study from our sources about a hypothetical stock, XYZ Inc., and a trader named Alex.
Okay, so Alex has been watching XYZ Inc. in a strong, steady uptrend. He's already made money on the long side, but he recognizes the trend is getting old. He's looking for a high-confidence signal to exit or maybe even flip short.
So he's patient. He's waiting for the market to give him a definitive sign. And one afternoon, he sees something striking at the top of the price channel.
He sees the bearish engulfing pattern form. A small bullish day gets completely wiped out by a massive, aggressive bearish candle. That's the primary pattern. That's his first trigger. It tells him sellers have taken control.
But Alex knows better than to trade on just one pattern. He immediately looks for confirmation. So what did he check first?
He pulls up the RSI, and sure enough, the RSI had just crossed into the overbought zone above 70. This means the momentum of the previous weeks was likely unsustainable. The pattern said reverse, and the indicator said exhausted. This increases his confidence dramatically.
So with that high probability confirmed, Alex decides to enter a short position, anticipating the reversal to continue. But he doesn't just jump in unprotected.
And this is crucial. He places his stop loss just above the highest point reached during that engulfing pattern. This is his line in the sand. If the price rallies back above that, his analysis was wrong, and he minimizes his loss automatically.
Right. And the price declines over the next few days, confirming the reversal was real. Alex, being disciplined, uses this new information to adjust his stop loss downward, trailing the price. He's locking in profits and removing risk.
Finally, he doesn't get greedy. He knows reversals don't last forever. He exits his short position when the price reaches a major support level he had identified earlier, a point where the price previously consolidated, and which also aligned with a 38.2% Fibonacci retracement.
So he used a multi-layered approach. A candlestick pattern identified the entry, the RSI confirmed the timing, and a combination of price action and Fibonacci dictated his exit. That's the power of context.
This really raises an important question. What stands out to you? We've covered a lot of specific techniques, but I think 4 key takeaways truly matter for anyone looking to apply this.
Okay, number 1. Patterns like the engulfing, the morning star, and the 3 black crows provide valuable early insights into potential market shifts. They basically translate market sentiment into geometry.
Number 2, confirmation is king. You should always combine these patterns with tools like moving averages, Fibonacci, or RSI to drastically improve accuracy and filter out the noise.
Number 3, risk management. It has to be integrated into the pattern. Using stop losses placed strategically just outside the formation is simply non-negotiable to protect your capital.
And finally, number 4, context matters. You need to analyze the patterns within the context of the broader trend. And remember that the depth of penetration, like closing past that 50% midpoint, is often more important than just the color of the candle.
Right.
So since we know these patterns work best when they align with major support or resistance, consider this. How much weight would you give a bearish engulfing pattern that forms in the middle of a price channel with no significant levels nearby, versus an identical bearish engulfing pattern that forms precisely at the all-time high of a stock? The location doesn't just influence the trade, it entirely dictates the probability of success.
Yeah.
That alignment between pattern and price structure is the last layer of mastery.